All righty. Hello, everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab. And as promised, when you guys fill out a survey, I read each and every comment. And one of the comments the other day was from Trading a Smaller Account. And it said, I used to love this class so much, along with trading price patterns, but you're doing more stock examples now, and I don't like it. I like it better when you just trade options. And then, I get lots of comments saying, I'm kind of new to options, so I'd really like it if you threw in some more stock examples. So, sometimes you can't win for trying, but it made me think as I was looking at different stocks prior to the starting of the class today, that there's a lot of value in comparing stock trades and option trades, and there are benefits to both sides. So we're going to talk about trading stocks and options within the context of trading price patterns today. So if that's a mouthful, well, yeah, there you go. I would like to welcome Mr. James Boyd, who is joining us in the chat. He teaches each and every day. And today is no exception. He'll be teaching, I believe, at 4 o'clock Eastern today. So you won't want to miss that. James and I would like to invite you to follow us in the Land of X. My handle, Barb Armstrong CS. James Boyd CS. So, yes, somebody's asking if we'll look at the McDonald's Iron Condor. So that's in my trades gone wrong category, and we'll definitely look at that today. Oh, it's at 3 o'clock Eastern. Okay. So that James is teaching today. So as we, get into the throes of our topic today, know that options carry a high level of risk and are not suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn, to become familiar with the platform, and to make sure you understand your trading strategies before you consider trading them in a live account. There are some nuances and differences. One is that short options will never be assigned early in Paper Money, but that can happen in a live account. And one of the things that we're going to discuss today is, what can happen if we're assigned. So that will be part of our conversation today. And so let's get out and start by having a quick look at the platform. So we're going to start with the S&P 500, and it had a great fall. The NASDAQ rolled even further down the hill, but it's made quite the comeback since it hit this bottom back here on April 7th, and is continuing to kind of mosey on up that hill and move to the upside. When we look at the NASDAQ, which is our tech-heavy index, and by the way, if you're following me on X, look at, by the end of the day, there should be a short video there on just what the S&P 500 is all about. So if you want a little refresher on that, it'll be a quick video on the S&P 500. So be there, be square. And, look at this NASDAQ. I mean, it is almost back. It's within a stone's throw of its all-time highs. So, the comeback kid, right? When we look at the Russell, it hasn't come quite as far back, but we're seeing a lot of similarity in these patterns. And we've got this big inverted head and shoulders pattern where it broke out, and now it's flirting with that resistance line. And the expectation is that this line might hold, or this range might hold as a support level. And so, stay tuned. We'll see how that plays out. And then when we come and look at the Dow 30, this is unlike the NASDAQ and the S&P in that it is based, the weighting of the stocks within the Dow 30 are based on the price of the stock as opposed to the market cap. Yeah. Yeah. So, and again here, we had this inverted head and shoulders pattern, but it hasn't cleared the resistance rung. It's back underneath. And it's like, so what's going on, my friend? So it may, looks a bit like it's kind of consolidating and going a little sideways. So we'll just have to kind of stay tuned on that and see if it finally busts a move and gets above that, 427-ish range and stays there. And then when we look at volatility, still under 20. Well, it's at 2031. But it's back in kind of a more normal range, or more closer to the range it's been trading in for a lot of the last year. So that's where we're sitting, just as a very broad overview. Kevin Horner does a great class called Trader Talks at the beginning of the market day, 4 days a week. And so you may want, if you want to get into the thick of things, you may want to tune into that. Okay, so people have been asking about McDonald's. So let's start there. And McDonald's, we've been trading iron condors on this thing pretty successfully, for the last few months. But the last one we placed, we had our short call vertical up here. And when it bottomed out, we bought this back for, 4 or 5 cents. But now this sucker this week, well, and you're going like, what's happened to Mickey D's? Argus downgraded it to hold from buy, and probably dropped the price on it. And it has fallen 3 days in a row. And this thing expires at the end of June, but we want it to stay above 300, and it's now sitting at 290. Now, some might say, well, we position sized appropriately, so we could give it some time. But if you're saying, when I look at these positions, if it's kind of a clear break of support, we had that clear break of support on Monday, and then it's continued to fall. So it's down almost, it's down, 0.7% again today. And so how is that looking? So let's come up and look at our McDonald's. And, we're at 405. And that kind of shocked me when I first started trading verticals, because I thought, well, gee, if it's through both strikes, I'm obviously at max loss. And we only have 9 days to go, and we still could lose another $100 on this. And this is just, so we're looking at, we're down $318. We could be down 400 plus. Okay. So we're just going to say, you know what? This one did not go according to plan. And I was listening to a very successful trader. Let me put it to you that way. He's the head of this investment company. And somebody asked for one of his tips on success. And he said, when you're wrong, admit it quickly. So, although we'd like to make money, a small loss beats the stuffing out of a big loss, doesn't it? So we're going to just say, you know what, this one, we'd rather, get out having lost 318 than, 416. So we're going to take our lumps and close that out. So there goes that one. There's one other one that's underwater, and that is a short put vertical on Charter. And what is different, you guys all know, I'm a big fan of Sesame Street, even as an adult. Yes, I am. And which one is not like the others? I don't know if any of you ever saw Sesame Street, but this one is not like the others. And why is it not like the others? It's because it has this little ITM beside it, meaning in the money. And this, even if it's in the money, you only get the little ITM sign when it's expiring this week. So this sucker expires in 2 8days. And we are now, it's interesting because we were not below both strikes. We were at below one strike, because it was when I last looked at this about, half an hour ago, this was at 380.50. So it was in between the strikes. And what happens? Let's just pretend that this rebounds a bit. We do nothing. Tomorrow the markets are closed. And on Friday, it closes at 381. What would happen if it closed at 381? And let's come out to the charts and bring up Charter. So 385, and let's put the 380. So if it closed at 381 and you did nothing, it would be in between the strikes. And so the short strike at 385 would be exercised. The short strike would be exercised, which means what? Which means you've just now bought $38,500 worth of stock in an account that only has $25,000 in it. So what would you expect to happen? Well, you'd expect a little knock on your door or, a little ding-a-ding-ding on the phone to say, excuse me, Barbara, but you need to add some more money to your account. Riceburg is, yeah, you're absolutely right. Like, the potential for assignment is really, really high. Like, unless someone has put something in saying, do not exercise, plan on buying the stock, having the stock assigned to you. And if it closes at 381, then this side would expire worthless. So now you own $38,000 worth of stock. You don't even have enough money to buy $38,000 worth of stock. And if this were to fall over the weekend, or if the whole market were to fall and this along with it, you could now lose more than your potential max gain, or your potential max loss, rather. And so it's interesting to me that we're now below both strikes, and yet have we incurred our max loss? Well, we're at 295, and our max loss would be if it's at $5. So we could still lose another $2 and change. And given that the market is closed tomorrow, and then I am going to be playing with my grandson and not hanging out with all of you on Friday, I want to take care of business. And has anybody else ever been in that position? You're going on a vacation, or you have company coming into town and you don't want to spend your day looking at the market? Yes. And if somebody is saying, could this be assigned even right now? Absolutely. And that was one of the problems with Mickey D's, right? Is like the further it is in the money, the higher the probability of it being assigned as we approach expiration. So with Charter, we're just going to take our licks on this. We're going to come up to our working orders. We wanted to buy it back for 34 cents. Yeah, that didn't quite work out. So we're going to cancel and replace. And you may be saying, yeah, well, you're pretty chipper skipper, but I wouldn't be so happy if this were in my live account. If you trade enough, this is going to happen in your live account. And then pat yourself on the back for having the guts to admit you made a mistake and to get out without taking your max loss, or without it being assigned and then you're going, I wish I'd listened, because now I'm not down $300, I'm down $1,500. Okay, so that's our short put vertical. Now, there was another question in the chat, and I really love all these questions that are coming from like Sia and a Mighty Mouse and Alecha and Riceburg and Maximus Investor Guy. And he said, well, if we think, so Maximus, his question on Mickey D's was like, hey, if we think it's going to continue to go down, maybe we just close out the short strike and let the long strike run. And that is a potential. But when I look at this, and play I Spy with my little eye, what I'm seeing is that it's at a potential support level. And although it could bounce, it's a long road to Tipperary. It's a long way to come back up above 300. Now, if we bring up one ATR on this thing, how much does this stock, this answers would answer the question you might ask yourself, which is, hey, how much does this stock move in an average day? Well, from top to bottom, about $4.87 over the last 14 days. So, it's not impossible for this to move back up $10. But when we look at this chart and look at the fact that it was recently downgraded, et cetera, do we want to put our money there? And we're saying, yeah, no, we want to take what's left of our money and leave. Okay. Okay. So that's McDonald's. So those are the two management things I wanted to review. And today those happen to be trades gone wrong. Okay, so let's come and look at Affirm. So it is a firm called Affirm. Sorry, I'm feeling a little punchy today. Come on, come to mama. Okay, so what do you guys see on this chart? What kind of pattern are we looking at here? What kind of pattern? So, if I look at this and I see that it's been consolidating, right? It's gone a whole lot of nowhere this year. But this month, and it's what, the 17th, 18th of June, it's up 19%. So, and it's having a pretty good week. Yeah, you guys are right. Like it's, some might say, I see a cup and handle, totally legit. Here's our cup. Oh, my drawing tool is going to be acting up again today. So there's the cup and there's the handle. Or an inverted Head and Shoulders. And whichever way you want to see it, the way a technician would measure this is, say, if you're looking for a potential move, say it's gone from, about 33 to 57. So, that's not nothing. That's about a 24-point move. And so if we added 24 to our 56, 66, 76, 80. So that's kind of like a big swing, like up to this. So could we make our target here 80? And this is where I want to talk stocks versus options. Because if we buy the stock, and we have a max position size of 5,000 in this account. So, we can't buy 100 shares because that would be breaking our position sizing rules by a smidge, because it's at 61. But we could buy a number of shares and then put in a target of 80. And we could use this 56.87 and say, hey, if it goes 3% below that, I want out. So that would be at 55.16 would be our exit. And if we're getting in at 61.94, we're risking, okay, let me just close my drawing tool. So we're risking how much a share? So 61.86 minus 55.16. So we're risking $6.70 a share. And so if we're saying, well, we don't want to risk more than $500. So if we take 500 divided by 670, saying, we could buy 75 shares. So if we bought 75 shares times, let's just call it 61.80, that'd be close to our position size, like our max position size. So we're going to buy 75 shares. We're going to put in a target of 80. We've got $17,000 here we can invest. So we're going to buy custom with an OCO bracket. We're going to make our target 80. Now, you might want to make it 79.50. I mean, we're going to watch this just like we did with the Meta trades where, you know, we had a whopping 8 shares. And we may go back and look at Meta again today, spoiler alert. And 55.16 is going to be our exit. 55.16. And we're going to make this good till canceled. And we're going to put this in our stock with targets, and we're going to compare this to our option trade. Because we're going to look at, I was going to say long call, but you know, can we afford to do a long call? And why am I saying that? Well, one, you know, one thing about buying stock, oh, did I buy 100 shares? Okay, I'll adjust that later. We bought 100 shares. We weren't supposed to buy 100 shares. We were supposed to buy 75 shares. Okay, so one thing about buying the stock is, you know, it could take 3 months to get up there, and we're okay with that. You know, and if it takes 3 months, and let's say it gets to 80, and we got in for, let's just, to make the math easy for me, 62. If we made 18 bucks a share divided by our $62 investment, that's a 29% return, my friends. But, you know, so if it takes 2 or 3 months, like we're good to go. So, and it could take that long and it could never get there. So if we're going to buy a call, you know, we want to give it a certain amount of time. Like, so we might want to go out to September saying, hey, this could take 3 months. And remember, we don't want to risk more than $500. And how much are these options? Well, they're not cheap. So in order to do this, we can't buy a strike that's in the money because how much could we lose? We could lose all of it. So, you know, it's kind of like going to an expensive menu, going to an expensive restaurant, and you make your choice based on the right side of the menu. In other words, what the price is. And you'll hear comedians talk about like market price and how it makes them sweat if they're on a date, you know, which just cracks me up. But so if we say, hey, you know, I've got to give this some time. Okay, because time decay and time is going to start chipping away. So if I don't want to risk more than $500, and technically speaking, I could lose all of it, then that means I'm going to come out here to the 72.50 strike in September. If I want to give it even more time and protect it more from time decay, then I'm going to have to come out, you know, even further. I could come out to November. But if I want to give it, say, to September, we'll compare this, and we're going to buy custom. I'm just going to put it in as a buy. We're going to put in our buy custom order a little differently here. So we're going to buy one of these. We're risking $510. We could lose all of it. And then we're going to put in a first trigger sequence. Create a duplicate order. Oh, sorry. Didn't mean to do that. Let's delete that line. Whoops. Okay. Do it again. Buy single. First triggers. Came up with 2. Oh, for crying out loud. Okay. Buy single. Right click. Opposite order. There we go. And we're going to make it a market order because we're going to try and make this kind of quasi apples to apples. and we're going to put in the same target and exit. So our target, did we make it 79.50? I know we were going to start with 80. So 79.50. And if the stock goes below 55.16, we want to sell this for whatever it's worth. Now, can we change our mind on these as we go? Absolutely. On our exits, it's not set in stone. But so we're buying a call on a firm because we're bullish. We want to sell when it gets at or above 79.50, or we want to bail if it goes below 55.16. And how much could we lose? $515. So we're going to put that in our long call group, and then we're going to compare this to our stock. Yeah, and somebody said, like, well, would you want to sell the puts instead on a firm? So we could sell a put. And if we wanted to do a three-way comparison, we could come out and if we wanted to look at a shorter time frame and say, well, I could look at it's trading at 50. If we look at this 55 put, we don't think it's going to go down to 55. And so if we sold this put, we could end up owning the stock, right? Right. At $55. But what we'd really be looking to do is just make this 144. Yeah. Yeah, the reason that we went out to September is that we're recognizing that the expectation is that it might well take a month or two to reach that target of 80. And so if we're looking at this 55 target, it's below, if we were to sell a put. Now, if we sell the put and 100 shares are put to us, do we want to own 100 shares? Not necessarily. We might not want to end up owning any, so we could just sell it. But we could also say, hey, if it's put to us, maybe we keep 75 of the shares or 50 of the shares. Okay. And so that's another way. And some people will use the selling of puts as a way of acquiring the stock. Now, I was always a little hesitant about that because if I really wanted to buy the stock, you want to sell the put in a place where you think you're more likely to be assigned. And so the risk of assignment goes up. But if the stock is really moving up aggressively, you could end up with the credit from the short put, but then you don't end up owning the stock, which is what your intention was. And so if you're saying, well, I really want to own the stock, then maybe you'd rather sell the put at 60, where the probability of you ending up owning it is higher. Do you see what I'm saying here? So like if we came out here to July 30th and we sold the 60, this is the at the money strike. And it's saying, hey, you have a 46% chance based on where this stock is currently sitting. And this is a pretty volatile stock. The implied volatility on this is 65% almost. And the expected move up to $9 up or down. So if it just takes off, we end up with the credit, but then we don't end up owning the stock. And in a live account, it's highly, many traders wouldn't be placing 3 trades like this on one stock. We're doing this because we're in a learning situation where we want to compare. And if you say, well, hey, if it got put to me at 60, and I get paid $325 for it, it's like buying it for $56.75. If I take 60 and I subtract call it 320 now. So 56.80. So like that's my break even on it, 56.80. Okay. So let's do a three-way comparison. I like to run a semi-democratic class here. So we're going to sell a put also, and then we're going to put in an order to buy it back when we've got 80% of our max gain. Now, you may say, I look at my trades every day. I'm not going to bother doing that. But, next weekend, I'm going to be in New York for the market drive, and maybe I'm not paying attention, and maybe I could have got out with 80% of my max gain, and that would have been a bit of all right, but I didn't, because even though I think I'm going to look at the markets every day, sometimes we don't. So now if you're saying, hey, under no circumstances do I want to end up owning shares of a firm, then maybe instead of selling the 60, you would sell the 55 and take, half the credit and say, but then the probability of owning it is going to be, of having it put or assigned to you, is going to be less. And, and this probability of in the money says you've got an 87% chance it's going to come down and kiss that, at least. And so if it does, like, we aren't going to be hyperventilating, right? Right. Because we know that the probability is high because we're only $1.50 above it, that it could come down and hit that 60 mark. Okay. So we spent a lot of time on a firm today. But we hit a firm, 3 different ways. And so we're going to put that in our short put group, and we're going to compare to the stock and the long call. Okay. So there's that one. Let's have a look at Goldman Sachs. Do you see something similar here? Anyone? I must really like inverted head and shoulders patterns. Either that or, I just refuse to look at something lately unless it has one, or, maybe you see what you want to see. But I look at this and I'm kind of seeing another, and it's not textbook perfect, but, kind of maybe it's more of a cup and handle, really. Maybe I just like drawing inverted head and shoulders, but it's inverted head and shoulders-esque or cup and handle-esque. But the way you'd, measure the anticipated move is, 446 to 618. That's pretty big. We'll call it 619. And these are ranges, people. So, they're not that specific, but this is a range of 173. So that is a big range. But if you're saying, range smange, I see that this has broken above. It was kind of flirting with this resistance level and is now moving decisively to the upside. Could I sell a vertical below that? Could I do a 615? And it's too high. Are you just setting me up, James? Yeah, because it has moved pretty dramatically, but the whole market has moved pretty dramatically since April 7th, which happens to be the day this bottomed, also the day the S&P 500 bottomed. So could we do a short put vertical here and come out maybe 23 days? And it's really interesting here because it looks like this was a short put vertical. Somebody did 1,800 contracts at 625 and 620. Like, that is a bold move, my friends. And I kind of looked at that and went, oh, 625 and 620. Like, it opened today at 623. So that would have been in the money at the beginning of the day. And like, some people just want to be a little more conservative. That might be me. or it could be anybody. It's not that this is a recommendation from me, but if we're trying to align things and say, well, this has a delta of 41, so you've got a 56% chance of it expiring out of the money. If we go down to 620, we've got a 65% chance of it expiring out of the money. Now we're going to make less at 620 and 615, but at $1.42 for a trade we're in for 23 days, 142 divided by $5, well, 140 divided by 360, so 358. That's still almost a 40% potential return on our risk. So we're going to come down to single order, create an opposite order, say, hey, when this is worth about 28 cents, we want to buy it back. Now, could we buy stock and put a target on this? Sure. Could we buy a long call? Oh, this is a $600 stock. So buying a call, yeah, that's probably going to be out of our snack bracket. Like, unless you went like way, 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 way out of the money. Like, look at this. This is even 30 days out. Like, an out of the money call, like $25 above where it's currently trading is $1,300. And so you might say, okay, well, maybe I'd go out 30 days and do a long call vertical. Like, I might be willing to do that, at maybe 635, 640. But to buy a call, it's just such an expensive stock, like 10 times more expensive than a firm was. And so sometimes the price of the stock is a determining factor in how you trade it, depending on your account size. So here, we've now gone from a risk of $1,800 to, buy the 635 or $1,900 to 270. And if we say, okay, I want a 25% return on this, so I'm going to put my target at, 340. So first trigger sequence. Oops. I don't know how I did that. Let's just delete these. Okay, try it again. We're buying a vertical. Okay, right click. Opposite order. We're going to make this 340. Well, let me just see. Prices keep changing. 331. We'll make it 330. Good till canceled. We do 2 of these. We're risking $530. We're okay with that. And we're going to put that in our long call vertical bucket. Now, might we want to compare that to buying the stock? Well, you might say, well, we could, but like, it's not even worth it because it's a $600 stock. It's like, well, with Meta, we bought 8 shares. So if we said we're expecting this move of 619 minus 446 of 173 potentially. So what if we said, okay, the current price is 637, I can buy $5,000 worth divided by 637. I can buy 7 shares. So what if I bought 7 shares? And then I put an exit, here's a recent low right here. at 609.59. So my stop going to be 609.59. And if we just go at 3% less as an example, it would be 591. 591.30 is our stop. And we're going to do 7 shares. And our target is going to be 162 plus 618. 780. Now, what's another way we could determine a target? Well, we could use Fibonacci's, right? I'm doing this for you, James. Actually, we're going to talk about Fibonacci's and getting started with technical analysis over the next couple of weeks. So if we went for the 161 extension, we go from the top of this pattern to the bottom, that would have a target of 729. And so some might say, well, that's a little more conservative. I'd rather do that. You can do whatever you want. You know, so if we said, okay, 729 is going to be our target, we'll make it 729 instead of 780. It's like, okay. So we're going to come to the trade tab. We're going to right click. We're going to buy custom with an OCO bracket. The first thing I'm going to do, because I mean, this order wouldn't even go through. We're buying 7 shares, and then I'm going to click and make this into a paper clip and get these numbers to match. And our target is going to be 729 based on the Fibonacci's. And our exit is going to be 591.30. 591.30. Make these both good till canceled. And so when we look at this, you know, we want to sell it when it goes up by $91.85 to $729 based on the fib targets, or if it goes down $45 a share based on, you know, the recent low and 3% below that. Our position size, 4,461. This is another stock with a target, and we're going to compare that to a long call vertical. Okay. And yeah, you know, the recent high was 672. So, you know, maybe it gets to 672 and it starts to pull back. Would we be surprised at that? No. But we'll monitor this as we go. So I hope I've kind of appeased both sides of the house today in talking about both stock possibilities, examples, and option examples, and then some of the pros and cons. And you know, the biggest concern of an options trade is that there's a deadline with it. With a stock, you know, if it moseys along for a few months and ends up at about the same price, you haven't lost anything, but you haven't gained anything. I mean, there's opportunity cost. But but if you buy an option and it doesn't go according to plan, and it's basically the stock is still at the same price 3 months later, this option will be worth very little. It will be worth less and close to worthless. And so these are things we have to take into account. And so today we did, you know, a little bit of trade management on McDonald's. We also did some trade management on Charter, and I'll make sure that we've exited that position. And then we did 2 trades on Goldman Sachs, and we're going to compare those. And 3 trades on Goldman Sachs, and then 3 different trades on Affirm. And so, you know, we covered a lot of ground. So here's the deal as we wrap. Please don't forget to follow us in the Land of X, Barb Armstrong CS and James Boyd CS. Please hit the like button. It helps move things up in the algorithm so more people can find this content. So if you would do me a favor and hit the like button, that would be much appreciated. And then don't forget to subscribe to the channel by hitting the bottom in the bottom right corner if you haven't done that already. So, and if you're looking for example trading plans for the short put vertical and the long call vertical, there's also a stock trading plan in there as well, and a long call trading plan. Go to Trade Management Mini Sessions. So guys, thank you. Thanks to James for his help and the guys behind the scenes for all they do to bring this webcast to life. Stay tuned, lots still to come your way. Bye for now.